Would you like to know the best option trading strategies for hedging? Hi, I'm Larry Gaines, Power Cycle Trading. In this video, I'm going to show you what I call, what one of my members actually coined, the opportunistic hedge trading management. So this is an example of what this really comes down to, and this is on a stock INCY to show you an example of this. So on this particular stock, we were looking for a move to the upside. So we actually went long call debit spread on the 23rd of May, looking for a potential move to 145. Okay, so kind of a targeted trade to 145, and then it hit partial profit at 140. So let me walk you through this opportunistic hedge trading management process that was done on INCY. So I'll walk you through the trade setup based on the chart first. So on this particular trade, we went long a call debit spread right here on the 23rd. The next day it spiked up, so we took some partial profit here. Then the next day on the 25th, got to this first target area of 140, so converted this to a butterfly, okay, by selling a bear call credit spread. And I'll show you all this in just a minute. Now it came back down, so we did that. Now we totally reduced our risk from that. And then on the 30th right here, it broke this 8 exponential moving average, so we added another bear call credit spread here on the 30th. And then so we were now into what we call a call ratio butterfly, and then on this date on the 5th it broke this major moving average of the 21, so closed out the debit spread side and just left on the credit spread for a nice profit that ended up, you know, $50 per spread. So here we're at the progression going through the option series. So on the 23rd, bought the 140-145 call debit spread at $1.45. Then one day later, on the 24th, sold partial profit at $1.99, so took some profit there. And then on the 25th, one day later, when it was up at 140, to convert it to totally neutralize the trade, reduce the risk, sold a bear call credit spread at 145-150 right here, same series. Brought in a $1.20 credit, so that converted this from potential risk of 145, the debit spread, okay, 145 potential loss if it was to go down, to a risk of only $25 to the downside or upside. Now, when it broke back through the moving average, converted it to a ratio butterfly on the 30th by selling another bear call credit spread, same strikes, the 145-150 at 45 cents. So now that brings in additional credit, and now this is a $20 credit to the downside. Risk is more to the upside, but if it keeps going down, you make $20. And then when it broke through that major moving average on the 5th, closed out the debit spread that was at 145. Closed that out at 30-cent debit, so took a loss there of 115, and what that left this trade with was then being net bear call credit spread at $50. So this will be a max profit trade. Currently, you can see it's trading at 118.50, and this is a short bear call credit spread at 145, 150, 50-cent credit. So that's kind of what we have coined the term opportunistic hedge trading management, taking this particular trade from a long trade, totally shifting it, adjusting it to a short trade, and ended up with a $50 per spread profit.